the Fed's forcing rates down to 3 or 4. That means buyers of the US debt today are going to get paid back in money that's worth a lot less than they're paying for it today. That feeds the hard asset trade. I think investors that wanted to see gold go up like a straight hockey stick straight up are wrong.
Do you think we'll get a 50% correction in the stock market this year like you're calling for?
I mean, I think the obvious one.
Joining us today is Michael Gentile. He's a strategic investor in the metals and resource sector, and he's a co-founder of Bastion Asset Management. We'll be getting his views on what investors should be doing in the current environment. Welcome to the show, Michael. Good to see you.
Hey, David. Good to see you again, David.
Your specialty is investing in the resource sector, so we're going to pick your brains on that sector. Before we get to that, though, I think investors would like to know the biggest themes, investment themes of 2026, beyond just the resource sector. Let's start with that.
I mean, I think the obvious one, for the last couple of years, David, it was hyper bullishness on AI. We've been seeing the market. I think what we're seeing this year is more, what does AI mean for the economy? Going forward, there's lots of schools of thoughts there. Deflationary, what does it mean for employment? What does it mean for software companies? Well, disruptive. I was reading this week about Disney and, being able to make a movie with a couple of prompts on AI and virtual actors. So the AI is going to have wide-reaching implications for many, many industries. I think the market's just in the really early days of trying to grapple with what the markets do, predict what the long-term impact will be of AI in industry. So I think we're going to see, more volatility. The one-way trade for AI has been all bullish, and now we're starting to see maybe some dispersion or some negative impacts or some fear of negative impacts from AI on some traditional businesses that have been very profitable and very durable. So that's one theme. Obviously, geopolitical, another one. More just, resource nationalism, onshoring, just that continued uncertainty is driving that trade there as well. I think that's one. The third one is just debt levels. I still have yet to see any government come up with a credible plan to de-escalate deficits and debt. The debt binge we've been on for the last 20 years or nonstop the last 50 years, basically.
The fact that sovereign debt has risen dramatically since a couple of years ago when I started interviewing you, and the 10-year yield has gone up in the last year and a half, there still isn't any signs yet of a sovereign debt crisis in the U.S. Why is that?
It's too easy to keep printing money. I think it's just shocking that we started talking years and years ago, pandemic time. And, when you had the pandemic and a massive recession, it made sense to print, for a short term anyway, some amount of money. They printed way too much in my view. But the fact that we're still ratcheting up record deficits and debt levels when the economy is not great, but it's doing okay. Like we're not in a recession, and we're still ripping the debt and deficits higher. So there's just not the willpower, David, I think, for the governments to tackle that. I think most of the government strategy is to try to print your way out of it or grow your way out of the debt levels, which is a very hard thing to do because when you do hit an air pocket or recession or some of the impacts of AI are felt in the economy, that can have really negative implications if you haven't taken care of your spending in the meantime. So I just don't sense the willpower. I don't sense the political desire. I don't sense the recognition in the populace that deficits are harmful. And I think we could talk about the implications on inflation and what this is doing to the middle class, but I just don't think we have the consensus to tackle it.
2025 saw record prices in gold, silver, stock markets, tech stocks, and Bitcoin and many cryptos. The last time that has happened with all those asset classes breaching new all-time highs was 2021. What's different this time versus 2021?
2021 was a massive amount of money printing in a response to an unprecedented pandemic. I think what's different this time is there's a real, long-term buyer of physical metals. I think you're seeing a de-dollarization trade. I think what's different this time is you're seeing countries with their central banks and their Federal Reserve balance sheets actually dramatically expanding the use of the gold versus the US dollar. And so that, David, that devaluation of the dollar, like I often make the analogy, is the S&P going up or is actually the dollar going down? Is the S&P just a good value preservation proxy for protecting against the US dollar decline? So if you look at the S&P 500, you look at a lot of the asset classes in gold terms, they're actually down. And so we got to be careful the bogey we use to measure. If we're seeing a devaluation of the dollar due to the massive amount of printing of paper bills that were circulating in the economy, you have this illusory feeling that you're getting richer because the S&P is up or Bitcoin is up or housing prices are up. But in reality, the purchasing power of those dollars are way down. And so what's different this time is the central banks are telling you with their purchases that we're entering a de-dollarization phase. We're entering a rotation out of the US dollar into hard assets again. And all the asset classes are going to go up in a sense when the US dollar is being devalued. But we have to look at it in a purchasing power or a preservation of wealth perspective versus just a nominal quote for the S&P 500 or for the Dow.
The fact that gold has risen to $5,000 and has stayed above $5,000 for quite some time. Today, it's at $4,800. Inflation, however, has not gone up proportionally. In fact, the latest CPI reading went down versus the previous month's print by 0.1% annually. What does that mean to you, Michael, the fact that inflation has not caught up with gold?
I think I'm not a big fan of the PPI numbers, David, because I think a lot of this stuff, the numbers in the PPI statistics, stuff you actually want to buy, like go to any restaurant, go on any vacation, go to a grocery store, go try to buy something, some clothes or some school supplies for your kids. Everything is up way more than 0 to 1 or 2%. So stuff you actually need is constantly increasing in price. The PPI basket that they use a lot of stuff that maybe people don't use, or shrinkflation, different things. People are shrinking the size of packages, or the measurement scores they use to measure those. So I think still inflation is a problem. And if you talk to the average middle class family in the US and Canada, they'll tell you things are tighter than ever in terms of their budgets. I also think that the economy is not doing great either. So if you took out government spending from the economy, David, I think we'd probably be in a negative GDP environment. All that debt that we're talking about is actually what's fueling the modest GDP growth we have in Canada and the US. And so inflation was also driven by a short-term supply chain crunch where we had no ability to move anything around the world for 6 to 12 months in 2021. Now that supply chain's back open again, we're not seeing the really robust economic growth that would drive the PPI higher. But in general, I think we're still seeing a consistent and persistent devaluation of the US dollar and increasing cost of living for stuff you actually need to own as a citizen. So people are feeling that pinch. And I think, anytime we have any tightening in the economy or any economic surge in growth, you're going to see those inflationary pressures build back up. The other side of that coin I think about a lot, David, these days is AI likely will have some deflationary forces to it. It's potentially very highly deflationary forces to it, just in terms of cost savings, labor cuts, productivity gains. So that also probably into early days is starting to keep a lid on inflation, which is another contrary factor to the inflationary forces.
Well, you told me offline that miners relative to the bullion are a little bit undervalued. Is there a chance that we're going to get a miners re-rating at some point? Is it going to be a factor of margins expansions from the producers, or the juniors just have to hit home runs with exploration and development and finding new deposits? What's the play here?
Yeah, I wrote in my weekly newsletter I send out on Saturday mornings. I had a dinner with a major mining CEO in Montreal a couple of weeks ago, and it's a very large cap mining company. He was shocked at how the market was selling off his stock, because he shared with me, in Q4, the average gold price was between $4,000 and $4,100 per ounce for the average producer. That was the average gold price in Q4. And if you look at the gold price today, Dave, you said it's 4,800. It's been above 5,000 for much of Q4. So just use 5,000 for round numbers. The gold price is up $1,000 per ounce quarter over quarter from Q4 to Q1. But reading the mainstream media and reading the commentary on gold, all you hear about is this big sell-off and big volatility and big decline in gold. But it's up $1,000 an ounce quarter over quarter. The average ASIC, the average industry all-in sustaining cost, David, like cash margin, it's by about $2,000 an ounce to produce gold. So if you take Q4, $4,000 gold price, $2,000 costs, on average, big generalization, producers are making $2,000 margin, which is 100% margin, right? The current gold price is $5,000 an ounce. So their margins went from $2,000 an ounce to $3,000 an ounce quarter over quarter. So their margins went up 50% quarter over quarter. And people are talking about a big sell-off and a big decline in the gold price. So just to put some perspective on that, that's why I believe the gold stocks are pretty cheap, because they didn't follow the gold price up when gold went up to $5,500 an ounce, and they've sold off on the pullback. But quarter over quarter, we're seeing massive, when we started talking in 2000, David, the average margin for a producer, if they were lucky, was $200 to $300 an ounce. $2,000 gold price, they have $1,500 costs. Today, they're $2,000 to $3,000 an ounce margins versus $300 to $400 ounce margins in the COVID time. So we've seen 10x on the margins per ounce. We have not seen anywhere near 10x on most of the gold prices. And on the junior stocks did not participate at all for most of the last 5 years in the rally, only now starting to come to life. But you can buy an average junior mining stock at $50 to $100 an ounce in the ground. In the context of a $5,000 gold price, you're paying, well less than, 5% or 4% of the gold price, or 3% of the gold price in that case, for resources in the ground. So the M&A environment should be very attractive for these senior producers that are printing money, literally, and can buy resources at pennies on the dollar in the ground, I see a lot of very creative opportunities for the producers and a lot of multiple expansion and cash flow expansion for the producing companies as well.
Before we continue with the video, let's talk about today's sponsor, Monetary Metals. With gold prices having hit all-time highs, we know why people hold gold. It's because it's real money. But what if your gold could do a lot more than just sit in a vault? Well, that's where Monetary Metals comes in. They offer a way for you to earn a yield on your gold paid in physical gold. Through their leasing marketplace, you can earn up to 4% yield per year in gold. That means instead of storing your gold in a vault and letting it sit idle, you can lease it out to vetted businesses in the gold industry and get paid in more gold. Thousands of investors are already earning a monthly yield in gold and silver through Monetary Metals. So scan the QR code here or go to monetary-metals.com/Lin. Link in the description down below to learn more. Don't just hold gold, put it to work. So what's the main thesis for being in the resource sector today? Are we banking on more M&A action? In other words, you should be positioned more towards the juniors, or are you banking on higher gold and silver prices still? In other words, the metals will raise NAV values, or are we banking on the overall equities index climbing higher in 2026, which, a rising tide will lift all boats, including the resource sector? What is it for you?
I think it's going to be kind of like you saw in the oil and gas sector several years ago, post-COVID, the sustained and rising profitability of that sector brought a lot of generalist money into the oil and gas sector to the point where most oil and gas stocks today are trading at 5 to 10% free cash flow yields, and they're pretty stable businesses and generating a lot of free cash flow. If you run that same math on gold producers at $4,500 gold, which is well below where we are today, you're talking 20, 30, 40% free cash flow yields in many cases for the producers. So I think if once investors get comfortable that the silver price is going to be, $60, $70 or higher for the long term, and the gold price is going to be $4,000 or higher for the long term, which are both prices that are below where we are trading today, you're going to see multiple expansion. In a world where you have a lot of uncertainty of the durability of free cash flow from multiple industries due to the disruption of AI and other geopolitical economic factors, the stability of that cash flow also will be very attractive to investors. So I think as investors look for a good, durable, long-term place to place their money that hedges against money printing, hedges against government debts spiraling out of control, hedges against de-dollarization, hedges against AI, I think the attractiveness of those cash flows in the mining industry can become more and more attractive. And what that means for investors, David, is the multiple expansion. You're going to see multiples expand, free cash flow yields go down, the stocks are going to go higher over time. I'm not here saying gold's going to 10,000, 20,000. You don't need that for these stocks to be extremely attractive. But the backdrop for long-term price support for the metals is very positive in terms of macro. And the investor attention is still extremely low, especially when you talk about European or American. Deep pockets of capital have not really rotated into the mining and metals equities at this point in time, in my view.
Well, the fact that gold's at 5,000 and silver is already, back down to 73, does that signal a top to you? The fact that we haven't progressed beyond $100 silver for a sustainable period of time, and then gold breached $5,500 briefly, but was unable to sustain above $5,000 for multiple weeks or months at a time. What does that mean to you?
No, I just think it's a big run up. Gold went from 2,000 to 5,500 in a span of 3 or 4 years. I think when you have big run-ups in anything, if you have healthy consolidation, you'll have more volatility. I think investors that wanted to see gold go up like a straight hockey stick straight up are wrong. If you're long-term bullish on the sector, this is very healthy behavior. You consolidate at higher levels, higher highs and lower lows over time. No, I don't think it's a top until I see tangible evidence that the governments are getting disciplined about their fiscal irresponsibility and balancing budgets and decreasing debt and stop printing money at every twist and turn. I think the macro thesis is there. I also think that much of the move in the gold price has been central bank buying. So from $1,500 gold to $3,500 gold, I'd say 95% of the buying has been central bank buying. And the last $1,500 gold move in gold has been some return of financial players who've all literally, sounds like basically on the speculative ratios or the net long commodity speculator ratios have all got washed out in the last little while here. So it's been a very healthy rally, David, because unlike other cycles, the buying has been sticky, long-term central bank buying and not hedge funds, financial funds that are looking to trade or get in and get out. And so that's the underpinnings of a very healthy long-term price versus in the past, it's been much more speculation and short-termism.
Can we attribute this mainly to geopolitical uncertainty around the world, which would necessitate central banks buying gold as a diversifier away from the dollar, and as other institutions as well doing the exact same thing because of uncertainty for what the U.S. is going to do with fiscal and monetary policies?
There's two buckets. So bucket one, David, I say would be people losing confidence in the U.S. government's ability to pay them back with dollars that are worth anything 30 years from now. So that's why you're seeing bond yield rising, why you're seeing a rotation out of U.S. dollars into gold. So one is fiscal concerns that I think are very real and will be hard to address in the U.S. So that you're going to have a kind of permanent bid there for protecting people's purchasing power by using gold and rotating out of US dollars. The second one is a geopolitical point. You saw gold really took off in 2022, or started to take off when the US freezed the Russians' FX reserves. So the Russians had about a third of their FX reserves in US dollars. And overnight, the US government said, you can no longer access those US dollars. So any country that's been at odds with the US over the last 20, 30 years, holding 70, 80% of their reserves in US dollars, ask themselves a question saying, if I end up on the wrong side of the US on a geopolitical dispute or even a trade dispute these days, are my US dollars at risk? Are my US currencies at risk? You saw an acceleration in the pace of central bank buying, the combination of lack of fiscal confidence in the US fiscal situation, and also the fear of, not expropriation, but freezing of your FX reserves and losing access to that reserve. So that's been a double-edged sword. And I think what's happened the last couple of years with the tariffs and I guess increasing tension between the US and other parties, that's fed that cycle. So can we solve the geopolitical noise? Probably that will fall a bit over time. But I still think the US fiscal situation is going to create increased buying. And I think countries are going to be, bite me once, twice shy, or be a little bit worried to rotate back into US dollars in a meaningful way. Even if we see a thawing in some of these geopolitical tensions between the US and other countries, I don't think they're going to be rushing back to get married again after being burnt the first time. So I think you're going to see a permanent shift out of the US dollar, and that these FX reserves outside of the US dollar will continue to grow over time. And that allocation away from US dollar should be a permanent fixture in our system going forward, I think, in my view.
Okay, Michael, I want to bring up something that you said to me not exactly, but about 5 years ago. You and I have been talking to each other for quite some time. You made a rather prescient call, and I want to just bring this up because it was perfectly called. You had said in August 2021 that if the Fed needs to really double down on fighting inflation, they're going to have to raise interest rates to above, the Fed funds rate to above 3%. And they're going to have to do so aggressively. That's going to cause a cascade of sell-offs across equities. Equities were crashed by the order of 50%. Some sectors did, by the way. So that turned out to be common sense. That played out perfectly, Michael, in 2021, because we saw exactly what happened in 2022. That played out in 2022 pretty much perfectly. Let's evaluate the Fed's mandate today and what the roadmap is today, given inflation and the labor market. What do you think they're going to do?
What they should do, what they will do, David. I think they need to keep a cap on rates because the math, we've been talking right for a long time, the debt is a heck of a lot larger than it was in even 2020 than it is today, David. So, the debt's $38 trillion today. Let's round that to 40 trillion, which will be there in a couple of months, probably at the pace they're spending money in the US. So say $40 trillion of debt, 30-year bonds, 4.5%. If you have a 5% handle on your money, on your debt at $40 trillion of debt, that's $2 trillion a year of interest expense. That's approximately about a third of the US fiscal receipts in any given year. Any business, any household that has 33% of their annual income going to just cover the interest on their debt is insolvent. And so one equation, you say, well, what I want to pay for a 30-year bond in the US, given the fiscal situation, I want a heck of a lot higher than 4 or 5% rates. But what's the Fed going to do? The Fed's going to do everything they can to keep that rates at 4 or 5% or lower. So, years ago, thank you for remembering that call, David, I said rates are going to go up a lot. I think it's going to be very, very hard for rates to go up from here. And so I think rates are going to be capped at this 4 or 5% max level for a long time and likely be suppressed lower, only because it's the only way mathematically the US government can float its debt. So the market says rates should be 7 or 8. Let's say mathematically to justify purchasing debt today, the Fed's going to try to manage those rates to 3, 4, 5% in the long term. That effectively means negative real rates, any way you want to call it. Forget the inflation number. Just say the market should be 7. The Fed's forcing rates down to 3 or 4. That means buyers of the US debt today are going to get paid back in money that's worth a lot less than they're paying for it today. That feeds the hard asset trade and saying, well, I'd rather own something that can't be printed, that can't be managed down. So I think the Fed's going to be capping rates. I think Trump is very, very vocal. He said a couple of weeks ago, the US dollar is still too high. He's constantly saying rates are too high. Clearly, his strategy is keep rates really, really low. grow the economy as fast as he can and try to outrun the debt bear by having high nominal GDP growth while not worrying about inflation or money printing to monetize the debt. That's his strategy. So I think the playbook from here will be suppressing rates in some way and allowing the debt to be floated with cheaper paper in the future.
If we get negative real rates, where does that leave investors seeking yield?
Yeah, I mean, you're gonna see negative real rates will increase people up the risk curve, right? Negative real rates allow hard assets that don't yield as much to become more valuable, but they also allow the S&P to trade higher. So I think despite the geopolitical backdrop, despite the threat of AI in terms of disrupting industries, you're still seeing the markets do very, very well. And I think that's a function of the markets saying, hey, we're going to be paid back in dollars that are worth less and less every year. So let me own assets that have pricing power, that have ability to pass pricing on to consumers, that can protect my purchasing power. And so to some degree, the Mag 7 has become another proxy of gold. And these companies have better balance sheets than the US government does. They have more cash on their balance sheets than most countries have at their disposal, and they have the ability to raise prices. So that's why investors are hiding in gold. They're hiding in the Mag 7. They're hiding in the S&P 500. But remember, buyer beware. Use gold as a good proxy to understand what your purchasing power is, and don't think because the nominal S&P 500 is making nominal new highs every year that you're getting richer. I mean, Argentina's stock market, look it up, has been making record highs for years upon years, but the population is getting poor because inflation and devaluation of their currency has been eating away at their purchasing power. Less dramatic in the US, but similar idea that you're going to see nominal highs in assets, but just beware of what those assets can actually buy you over time, like cash can actually buy you over time.
Do you believe that now more than ever there is an everything bubble?
Everything bubble, no, but I think what you're seeing is, again, when you print too much money and you devalue your currency, everything goes up. So you want to call it a bubble, or you wanted to see it asset inflation? I think we're in an asset inflationary environment where you're printing money, and therefore the hard assets that generate cash flow will be more valuable over time on a nominal basis. In real terms, that's another discussion for another day.
Okay. Well, silver versus gold. Let's just evaluate both of these. Silver has corrected much harder than gold, although both have moved in the exact same direction at the exact same time. I understand that there's a higher leverage to gold. There's a higher beta naturally to silver. But the fact that it's still sitting above $50 squarely, is this the floor right now? 73?
I always say, David, silver is a good thermometer for retail investors' interest in hard assets and precious metals. So when you saw gold go from 2,000 to 3,500, and you saw silver still struggling in that $25 to $30 range, people were saying, why is silver not going up and why is gold going up? I had a very easy answer for the last several years, and I'm pretty sure I'm right on it. The facts prove me correct, is that all the buying of gold was central bank buying. There was zero interest from retail and mainstream investors in precious metals. And so all the demand was going to gold, and central banks, 99% of them do not buy silver because you'd have to fill 17 football stadiums full of silver to actually have a strategic reserve of silver that actually was worth something to a government. So once retail started coming back, once gold went through $4,000 an ounce, it finally got the attention of the retail and more mainstream investing public. And that's when you saw silver really take off from like 30, 35 on a hockey stick to 120. So that told you retail speculators were back. The recent washout of silver has told you a lot of those speculators have got, punched back to the sidelines. So for me, I always use silver as a thermometer check on the mainstream interest. Today at $5,000 gold and $70 silver, you're in that, 70 to 71 ratio. It got as high as 100 to 1 ratio. I think the long-term average is like 80 something. So I think we're right about that right average of the balance between silver and gold. And from here, we'll see probably silver and gold moving in lockstep. If the market gets hotter, silver will lead like it always does. And if the market sells off, silver will be a 4x beta on the gold price. That's just the history of hundreds of years of precious metals trading. But I think the long-term backdrop for gold is positive, and therefore I think it's going to pull silver up with it. And I think if you really believe that we're going to see a major devaluation of the US dollar, and these trends are going to accelerate, silver should outperform. It's really a temperature check on how bullish you are in the precious metal space.
Silver's been in a structural deficit for years, though. Why did it move up so quickly, so suddenly? Was there actually just a rush of retail frenzy, or was there perhaps a squeeze from the supply side? Some people say it was because China placed further export restrictions on critical minerals, including silver, close to the end of the year, 2025. Was that part of the reason as well?
I take a more simplistic view on silver. I hear all those theories on structural deficit and solar and demand for silver. The reality is, David, when the financial markets get interested in silver, they dwarf by a multitude the traditional supply demand drivers of silver. The reason why, so I think the silver bulls can't have it both ways. It can't be a base metal like copper based on supply demand and a precious metal at the same time. I think when silver does well, it trades like a precious metal, and that investment demand dwarfs the demand of basic uses of silver in the economy. And when there's no demand for precious metals, it trades like copper, and it gets to be no bid, like when it's $25 to $30. So if you're bullish on silver, I hear you on all those supply demand theses, but what you really want to care about is, are more and more investors going to care about hard money? Are more and more investors going to embrace precious metals as a hedge to protect them against devaluation of the US dollar? That is the bull thesis for silver. And the supply demand stuff is really nice to have. But if you think silver's going at $200, it's not going on the back of solar demand. It's going on the back of more of your viewers, David, saying, I got to allocate some more money to precious metals and protect my purchasing power. That is the main driver of silver. And that's what's going to dictate its price movements 95% of the time.
Silver versus copper then, which has better fundamentals?
I would say, because I think precious metals demand has two facets. Silver has some base demand, but also has precious metals hedging of currency demand, hedging of fiat currency demand. I think silver probably has a better price appreciation over multiple years. But I like copper because it's simple. Copper is a supply demand dynamic. We need more copper, electrification for AI. The power demand we're going to see for AI is only going to increase over time. And we've had a massive underinvestment in the copper supply chain over the last 15 to 20 years. So I actually think copper is a more simple, bullish case over the next 10 years, but silver has more torque. But silver will be dependent on that increasing diversification out of the US dollar into hard assets, whereas copper will, I think, just do well, slow and steady over time, just due to almost unassailable supply demand. Unless you have a major recession, unassailable supply demand dynamics. You need higher copper prices. We cannot bring on more copper tomorrow. We need the price signal to bring on supply, and that supply is going to take many years to bring on. So I think you have a really, really nice 5-10 year outlook in copper, but it won't be as explosive as silver and gold have been the last several years.
Let's look at the flow of capital. So Bitcoin stalled. Some speculate that perhaps some of the money that went into Bitcoin went into the precious metals. Gold and copper and silver skyrocketed towards the end of the second half of 2025. And then we had a rotation into stocks sometime around 2025 as well, resource stocks, that is. At the same time, tech stocks, the bigger ones, started lagging behind the resource sector. Some speculate, in fact, I've read on CNBC, there was a rotation from innovators, 21st century innovators into 19th century businesses. Now that rotation has seemingly happened, what's the next big rotation, Michael?
So two things. I think Bitcoin, I've said for many years, and happy to have an argument with people, I think people bought Bitcoin because it was going up. And once Bitcoin's price appreciation, every cycle we've had in Bitcoin, you've seen smaller and smaller expansions in terms of percentage returns for investors. So I think once Bitcoin sort of stalled out and it's not made higher highs, and the velocity of returns available to investors in Bitcoin have sort of faded away, I think that caused the early rotation. What I like about Bitcoin is that it's taught a whole generation of investors on the value of hard money. I think Bitcoin's been the wrong horse to back. I think gold's been money for thousands of years. Central banks are stockpiling gold and not Bitcoin. And so I think for a lot of investors, they were backing the wrong horse with Bitcoin. I'm not saying Bitcoin's gone or dead in the water. I'm just saying that the narrative, kind of like on silver, the narrative on Bitcoin has been, it's gold 2.0. It's going to be ubiquitous and transactions. People are using Bitcoin to pay for anything. 10 years later, I don't know anybody that pays for anything with Bitcoin, except, a bunch of maybe cartels and different black market agencies. So it hasn't fulfilled its promise as a ubiquitous currency. It stopped going up, and I think my fear on Bitcoin was it has a lot of speculative money behind it, and speculative money, when the returns start to fade, looks for other places to make money faster. So that's kind of what's overhanging Bitcoin now. And I think the central bank purchases of gold have clearly picked the winning currency, I think, or the winning asset to really be backing the financial system going forward. To me, clearly feels like gold. On the rotation, I've been saying for many years, the next wave of the precious metals rally, David, is that the commodities rally will be when some of that big tech money rotates out of tech into precious metals and to hard assets. I think you might have seen 1% or 2% of that. I don't get the sense. The NASDAQ hasn't crashed 20%. There hasn't been a huge rotation out of tech into metals and mining. You've seen some pockets of money, mainly in Canada, chasing index weights of metals and mining stocks, but I have yet to see that big rotation. If you look back to the late 90s, David, the dot-com boom and the AI boom are very, very similar. In the late 90s, oil was depressed. China was gobbling up massive amounts of oil. Nobody cared. because everyone was fixated on the dot-com boom. Once the dot-com stocks rolled over in 2001, that kicked off a multi-year rally in oil that took oil from $10 a barrel to $140 a barrel. I see a similar trend when the tech rally rolls over, when there's a major correction in the tech stocks, a substantial one. Like I said earlier in the interview, investors are looking for safe places to invest their money, good cash flow, durable cash flow. That'll be the big rotation I'm waiting for. I think we've seen like the early adopters rotating up, but we have not seen a widespread rotation out of tech into metals and resources yet, in my view.
Well, if this rotation happens out of tech, it's gonna bring down the entire market, given how highly weighted tech is in the S&P itself. So I'll just ask you the next question point blank. Do you think we'll get a 50% correction in the stock market this year, like you were calling for in 2021, which basically turned out to be true in 2022?
50 is a big number. I think what I'm worried about, David, is the hype around AI. A lot of these, like the dot-com boom, in the 90s, I'm showing my age now because a lot of investors probably watching a show weren't around for the dot-com boom, but the AI companies don't make a lot of money. And so there's this whole food chain that's been built up. I think NVIDIA, 80% of NVIDIA's customers are cash flow negative. So anytime you have a business that has a $4 or $5 trillion valuation and 80% of your customers rely on the capital markets to fund their purchases of your product, that's a pretty precarious place to be. Nortel and Cisco in the late 90s were the NVIDIA of the 2026. They were the fiber optic cables. They were the guys laying the foundations for the internet. And so they were same model. They were selling their fiber optics, and all their customers were dot-com companies that had no cash flow and no earnings. And when the capital markets closed and when the music stopped, none of those customers could pay, and they had massive liabilities and receivables. Like Michael Burry and others are pointing this out as a bit of prophetically speaking about these issues. So if we're going to have a big crash in the tech stocks, I think it'll be on the back of investors realizing that while AI is going to change the world, and probably going to be even bigger than we think, like the dot-coms, internet is way bigger today than even the biggest bull in history in 1999 thought it would be. But most of the internet stocks end up being terrible investments. I think there's a bit of a risk of that in the AI market. And a lot of it's private, not in the public markets as well. A lot of the big AI companies are privately held and have big valuations in private equity funds or VC funds. But that's the main risk I see that could pull down the market, is that you could have the AI valuations drop by 50 to 75% and still have AI be a massive revolution for the economy, but not be a great place to invest their money. So that would be one area of fear. And I think if we lose control of the bond market, I think if the Fed is not aggressive enough, or you see Japanese bond yields or US bond yields really blow out because the market just doesn't want to buy the debt anymore, that's another risk, like I talked about in 2021, David, that if rates spike, we're vulnerable to correction, because in general, the valuation levels are not crazy, but they're quite high. And so if rates go higher, that's going to put a lot of pressure on the valuations of companies in the markets, and that could cause another big pullback.
Do you think the Fed, in that scenario, will the Fed implement some sort of yield control and intervene directly in the bond market?
Yeah, that's why I think that's why I was saying earlier, I think the bond rates should be higher than they are today, but the Fed will be pretty proactive in stopping that from happening. One, because the debt's too big to handle, and two, because the asset values is also what's floating the economy. The wealth effect, unfortunately, it's concentrated in the hands of very few people, but that is still floating. So you can't have the markets crashing and yields going higher and have a sustainable U.S. economy for too long.
Final question before I let you go, Ben. In today's higher volatility macro regime, what are some of the most important balance sheet or just financial statement metrics you're looking at to determine which gold or silver or any miners equities that you would pick? Basically, your evaluation criteria just based on the financials.
Yeah, in the mining sector, I would say you don't want to drink the Kool-Aid and be buying projects that only make money at $5,000 gold. I've been very disciplined in my mining portfolio, making sure I'm buying projects that have good IRRs at $2,000 gold or $2,200 gold. And therefore, the higher gold prices just dramatically increase your IRR and kind of give you bonanza level IRR returns. So a lot of investors make the mistake when commodity prices rise. They buy, pardon my language, crappy companies that can't make money at $3,000 gold, but can make money at $5,000 gold. In any commodity business, David, you want to be at the low end of the cost curve always. You can have some leverage to commodity prices and say, improving fundamentals as prices move higher. But in general, in a cyclical business, you want to be in businesses that are in the bottom 25% of the cost curve that can make money in any environment and just make a ton of money in a positive commodity price environment like we're in right now. For the market, for overall stock market, I'd say at Bastion Asset Management, we're very focused on companies that generate really good free cash flow and that have solid balance sheets. Warren Buffett says, buy companies that you can own with stock markets closed for 2 years. You're not worried. Back to my point earlier, most of these AI companies, if the capital markets are closed for 3 weeks, they're out of business. Whereas business that generates solid cash flow, can pay dividends, can buy back their stock, tend to do well in most environments and are not dependent on capital markets for their success. And we see a tremendous amount of value in the values, small cap stocks, Russell 2000, traditional cash flowing businesses that are underappreciated by the market because of the AI getting everyone's attention and the NASDAQ capturing everyone's attention.
Great. Thank you, Michael. Let's follow up next time. Where can we follow your work in the meantime?
Yeah, I mean, I've got a newsletter that I started a few months ago in the mining space. You can go to the website SaturdayMorningMining.com. It's not investment advice. It's not recommendations, but just updates on companies that I own, on my macro views, and any videos like I do with you this week are also posted in that weekly newsletter. So you can see me there. You can also catch me on LinkedIn. And I'm also on YouTube interviews quite often like this, sharing my views with the general public.
Okay, perfect. We'll put the links there. So make sure to follow Michael Gentile in the links down below. Thank you very much, Michael. Good to see you again, and we'll have you on again soon. Take care for now.
Always good talking to you, David. Thank you.
Thank you for watching. Don't forget to like and subscribe.